Warren Buffett is widely regarded as the most successful investor of all time, and he has built his reputation on the principles of long-term value investing and patience. One of his most famous lines was mentioned in Berkshire's Shareholder letter of 1988. Our favorite holding period is forever, inspiring millions of investors around the world to think and invest long-term. However, beneath this seemingly long-term oriented investing approach lies a hidden facet that may surprise many of you, because Buffett may actually be a short-term trader in disguise. While his reputation as a buy and hold investor has been solidified over the years, a closer examination of his investment strategies and market timing decisions reveals intriguing evidence that suggests Buffett's actions may reflect a more short-term oriented mindset than commonly believed. So in this video, we'll examine the claim that Warren Buffett, the legendary investor, may have been quietly practicing short-term trading strategies while maintaining his long-term investment reputation. So without further ado, let's get started. Alright, hey there, let me just outline the structure of today's video. So we'll first take a closer look at a scientific paper that actually analyzed all of Buffett's quarterly investing decisions going back all the way to 1980. And the economists then calculated Buffett's average holding period. We will then look at some more recent examples of Buffett's short-term trading activities and finally stress what you, as a private investor, can learn from the surprising data points that I'm about to discuss. And before we dig into the numbers, I'd like to ask you to take a guess. What do you think? What's Buffett's average holding period of individual stocks over the last 60 years? Pause the video now, think about it for a second, and then share your guess with the others in the comments down below. Okay, so the authors of the paper titled Overconfidence, Underreaction, and Warren Buffett's Investments examined the size of Berkshire's equity portfolio relative to the total assets owned, what industries Buffett likes to invest in, the level of concentration of Buffett's portfolio, the valuation of the stocks he invests in, and overall discusses whether investors should just copy Buffett's investment decisions. But those aspects of the paper should not really be the topic of today's video, and instead we'll focus on another part of the paper, because the authors also examined the average holding period, and what might surprise many of you is that while Buffett has held some stocks for very long periods, he in fact trades the majority of his stock picks much more frequently than you might assume. For instance, only 20% of all stock investments in this period were held for more than 2 years. On the flip side, as this table here shows, roughly 17% of stocks were only held for 1 quarter, approximately 30% of stocks were sold within 6 months, and more than 60% of his investments were not even held for more than a year. And then only around 4% of all holdings were held for more than 10 years. If you ask me, I think that's truly mind-blowing and certainly not what you would expect from Mr. Long-Term Investing, Warren Buffett himself. So please let me know in the comments down below what you think of these results and to what extent the numbers surprise you too. Also, I would love to know if Buffett ever bought and sold a stock within the same quarter, because then it would actually never show up in any of his 13F filings. There must be a stock like this, right? Anyway, the paper only covers the period between 1980 and 2006, but we can also find more recent examples of Buffett trading in and out of positions relatively quickly. The most recent one that comes to mind is probably his investment in the Taiwan semiconductor manufacturing company, ticker TSMC, of which he bought 60 million ADR shares worth around 4 to 5 billion in Q3 of 2022. And then, just 1 quarter later, Berkshire Hathaway revealed that it had dumped 86% of its total stake and then fully exited the position in Q1 of this year. So what's a possible explanation for this quick change of mind of Buffett? Luckily, Buffett himself commented on this short-term trade at the most recent Berkshire Hathaway shareholder meeting in Omaha. So let me quickly show you a clip from that meeting.
Berkshire bought a substantial position in Taiwan Semiconductor and, contrary to its normal holding timeline, sold almost the entire position within a few short months. While you cited in a CNBC interview that geopolitical issues were the catalyst, these issues were seemingly no different when you acquired that stock. So what else, if anything, changed in those few months and prompted the firm to offload close to $5 billion worth of Taiwan Semiconductor shares?
Taiwan Semiconductor is one of the best managed companies and important companies in the world. And I think you'll be able to say the same thing 5 or 10 or 20 years from now. I don't like its location, and I've reevaluated that. There's nobody in the chip company, there's no in the chip industry that's in their league, at least in my view. Marvelous people, marvelous company, but I'd rather find a marvelous people. I won't find it in the chip industry, but marvelous people and marvelous competitive position and everything. I'd rather find it in the United States. I feel better about the capital that we've got deployed in Japan than in Taiwan. I wish it weren't so, but I think that's a reality, and I reevaluated that in the light of certain things that were going on.
So clearly, Buffett didn't sell the shares because the fundamentals of the business changed, which rarely changed drastically over the course of 1 or 2 quarters. No, in this clip, Buffett stressed that he actually loves the competitive position of TSM and also thinks the management team is great. But instead, Buffett admitted that the geopolitical tension were his main consideration in selling shares in TSMC. I'm not really sure what exactly caused him to change his mind, because after all, Nancy Pelosi's historic visit to Taiwan, which certainly escalated the tensions between China and the USA, and then the subsequent Chinese military exercises around Taiwan, well, those events took place in August, so in Q3. But maybe Buffett bought TSMC before the visit, and then it just took Buffett a while to reevaluate his previous decision based on those more recent events. So if you know what changed the Taiwan thesis in Q4, feel free to share your ideas in the comments down below. Now, another more recent example that I was thinking of, maybe the airline stocks that Buffett invested in. He held these stocks for a little longer than TSMC, but in Q1 of 2020, so just before the COVID pandemic, Buffett was still increasing his stake in United and Delta Airlines, only to then fully exit all 3 airline positions just 1 quarter later, when the COVID pandemic was in full force and Buffett himself was apparently worried whether airline businesses would be able to survive the unique macroeconomic circumstances caused by the pandemic, as airline stocks and airline companies were basically burning billions of dollars each month with their airline fleets being forced to be parked on the ground. So what can you, as a private investor, actually learn from Buffett's willingness to trade in and out of positions fairly quickly? And what can possibly explain the surprising findings of the paper? Well, I've got a couple of thoughts on this, so please bear with me. First, the paper only covered the years from 1980 to 2006, and over his 6-decade-long career, Warren Buffett's investment style has obviously undergone a fascinating evolution. I'm pretty sure if you would analyze Buffett's more recent trading activity, say from 1990 till today, the average holding period would actually be longer. Especially in his early years, Buffett followed a slightly different and less long-term focused investing strategy than today. He was more focused on extremely discounted stocks, which he then sold once they have reached his fair value estimate. But as the asset base grew, Buffett had to slowly transition to a more quality and long-term focused approach, which is much more scalable and which allowed Buffett to build the fortune that he's known for today. But moreover, and maybe more importantly, Buffett's short holding periods may also teach you another lesson. Well, you should always think long-term and buy a stock as if you were buying the entire business and assuming that the stock market would be closed for at least 5 years. This doesn't mean that you are forced to hold it forever. If the facts change or if the price of the stock is trading at an ridiculous valuation, you are of course allowed to sell the position. I think that's an investing principle worth internalizing. So let me say it again. Buy stocks with a long-term mindset, but then continuously verify your investment thesis. In fact, Warren Buffett himself has articulated this very idea almost 35 years after making his famous "My favorite holding period is forever" statement. In the 2016 Berkshire Shareholder letter, he wrote the following: Sometimes the comments of shareholders or media imply that we will own certain stocks, quote unquote, forever. It is true that we own some stocks that I have no intention of selling for as far as the eye can see, but we have made no comment that Berkshire will hold any of its marketable securities forever. You also have to realize that these short-term trades don't really move the needle for the overall portfolio of Berkshire Hathaway. Most of the returns of all long-term focused investors are actually driven by the longer-term holdings and just a handful of big winners. Benjamin Graham's fund, for example, invested around $700,000 in Geico and then turned it into more than $400 million 25 years later, contributing more to his fund's performance than all other investments combined. Charlie Munger said the following about Graham's investment in Geico. More than half of all investment return in his whole life came from one growth stock, Geico. There were a lot of sort of lousy companies where you could make a little money floating from one to another, but the big money he made was one growth stock. So one takeaway here is that investing is actually a very forgiving discipline. Don't expect every investment to turn into a very successful winner. Many of your investments will actually be unsuccessful, will lose your money, and it's totally okay to sell your stock if the story doesn't unfold the way you were hoping. Your big winners, if you can hold them long term, well, they can easily make up for these failed investments. And of course, Warren Buffett and other great investors, like for example, Mohnish Pabrai, understand this principle as well. And Pabrai actually recently picked this idea up in a talk, and I want to share a short clip from a very recent talk he gave.
And then he goes on to say, in 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. And our satisfactory results have been the product of about a dozen truly great decisions, and which he's saying is about once every 5 years. So I tried to basically look at this period from like 65 to 22. And so, you have, let's say, 80 acquisitions in this 58-year period. He probably bought at least 210 stocks. So if you look at these decisions, there's about 300 important decisions. And he's saying that 12 move the needle. And so basically, it ends up being something like 4%. And I took a stab at what the 12 businesses might be. What was really important, if you go back to these decisions, the important thing was not that they bought these 12 or they hired a Jeet. The important thing was they kept them all. So it wasn't the buy that was, because they had, 288 mediocre to poor decisions. They kept those two. Right? So basically, in effect, they kept all 300. They lived with all 300 decisions. And it was really important for these 12 not to have been deleted or sold. So basically, when we look at this kind of statistic, what we find is that investing is a very forgiving business. But it is forgiving if you don't cut the flowers.
So Pabrai just included Buffett's Apple investment in his presentation. Buffett first bought Apple for Berkshire Hathaway's portfolio in the first quarter of 2016, and the stock has generated great returns since then and has arguably been Buffett's most successful investment ever, at least in absolute terms, as it's now worth close to $160 billion. But Buffett was also buying another tech name, IBM, and started to accumulate shares in this tech name in 2011 and then held the stock for many years. But then in 2017 and 18, he actually fully exited this position after the tech company had suffered nearly 6 years of declining revenues. But as you know, no one is talking about this failed investment today, but everyone is talking about the big success in Apple. And if buying super high quality businesses at attractive valuations fits your personality, I recommend you subscribe to my channel, leave a comment, and start binge watching some of my other videos right away. Take care.